There's a number buried in your rental property's paperwork right now that has nothing to do with your interest rate, nothing to do with your rent roll, and nothing to do with your credit score. And it could get your refinance denied or your loan flagged for review. It's called your DSCR. And in 2026, one boring, unglamorous bill is quietly wrecking it for landlords across the country. Your homeowners insurance renewal. Stay with me, because this is the kind of thing that doesn't show up on a BiggerPockets calculator, and most landlords don't find out about it until their lender says no. Chapter 1. The mechanism. If you have a DSCR loan, the kind most investors use for rental property instead of a traditional mortgage, your lender isn't looking at your personal income. They're looking at one ratio, your monthly rent divided by something called PITIA. That's principal, interest, taxes, insurance, and association dues all added together. Rent divided by PITIA. If that number is 1.2 or higher, you're usually fine. Drop below your lender's minimum, and you can lose access to refinancing, get hit with a worse rate, or in some cases fail to qualify at all, even if your property is performing exactly the same as it was last year. Here's the part nobody's talking about. Insurance is the I in PITIA, and insurance is the one piece of that equation that's been quietly exploding. Chapter 2. The data. Insurify projects the average annual homeowner's insurance premium climbing from $2,948 at the end of 2025 to just over $3,057 by December of this year. And that's a national average. In Florida, premiums have jumped 40 to 100% in the last few years alone, with several major carriers pulling out of the state entirely. And it's not just the coastal hurricane-prone markets anymore. Agents in the Midwest and Mountain West are seeing real increases too, driven by hail and wildfire risk that didn't used to factor into pricing. Chapter 3. Practical example. Let's make this real with actual numbers. Say you bought a rental in 2021 for $300,000. You're getting $2,200 a month in rent. Back then, your insurance was $1,800 a year, about $150 a month. Add in principal and interest around $1,150, taxes around $280, and your total PITIA was $1,580 a month. Divide your $2,200 in rent by that, and your DSCR was 1.39, comfortably above almost any lender's minimum. Fast forward to your renewal notice this year. Your insurer isn't dropping you, but your premium jumped to $3,400 a year, about $283 a month. Nothing else in the equation moved, same rent, same mortgage, same taxes. But your new PITIA is $1,713, and your DSCR just fell to 1.28. You're still technically fine on paper, but you've slid from a strong ratio into a much thinner cushion. And if your next renewal jumps again, or you're trying to refinance with a lender that wants 1.30 or higher, you could get repriced, denied, or pushed into a worse rate purely because of a mailed insurance renewal notice you barely opened. That's the trap. Your property didn't get riskier, your insurance company just decided it did. Chapter 4. Why it's happening. This isn't random. Reinsurance costs, the insurance that insurance companies buy to protect themselves, have spiked industry-wide, and those costs get passed straight to you. Combine that with more frequent severe weather claims, and you get 5 straight years of premium increases nationally, with no sign of it flattening in 2026 or 2027. Chapter 5. What to actually do. So here's what you do about it. First, shop your policy at every single renewal, not just when it's painful. Regional carriers and specialty landlord insurance brokers often beat the big names by a wide margin, and most investors never even get a second quote. Second, consider raising your deductible from around 2% of the dwelling value to 5%. That alone can cut your premium 15 to 25%, as long as you keep a reserve fund to cover it. Third, if you own multiple properties, ask about a blanket or portfolio policy. Bundling doors under one carrier often unlocks pricing individual policies can't touch. And fourth, stop underwriting new deals assuming insurance stays flat or rises 3% a year like most calculators default to. Build in 8 to 10% annual insurance inflation from day one so a renewal notice never blindsides your numbers again. If you own a rental or you're underwriting your first one right now, drop your city and your most recent insurance renewal increase in the comments. And if you want next week's breakdown on the new law that just capped mega investors at 350 homes and what it actually means for the rest of us, hit subscribe, because that's exactly what's coming next on Invest with Luvan.